The Australian Tax Office quietly collected over $15 billion in extra tax last financial year. Not from corporations. Not from billionaires. From everyday Australians who had no idea the rules had changed, who were still making decisions based on how the system worked 5 years ago. And in 2026, with 3 major tax law changes now locked in, the trap is bigger than it has ever been. Here is the uncomfortable truth. The tax system in Australia is not designed to hurt you. But it is absolutely not designed to protect you either. It is designed for people who understand it. Everyone else just pays more. And most Australians are paying more right now without knowing it. So today, I am breaking down the hidden tax traps that are quietly killing Australian wealth in 2026. What they are, who they hit hardest, and exactly what you can do before they take another bite out of yours. Let us start with the one that blindsided the most investors this year. The capital gains tax discount is changing. From the 1st of July, 2027, the 50% CGT discount that Australians have relied on for decades is being replaced. Assets held more than 12 months will now get a 30% discount cap, and cost-based indexation comes back into the picture. If you are sitting on an investment property or a share portfolio that has grown significantly, the math on when and how you sell just changed completely. Selling at the wrong time, in the wrong financial year, without restructuring first, could cost you tens of thousands of dollars in a single transaction. The investors getting hurt are the ones who hear about this change but assume they have time. You do not have as much time as you think. Now here is the one that catches the middle of Australia completely off guard. Negative gearing on established residential investment properties bought after budget night, the 7th of May, 2026 at 7:30 p.m, is now limited. You can no longer offset those rental losses against your salary income. For a household earning $150,000 combined, running a negatively geared investment property the old way and expecting your tax return to cover the shortfall, that strategy is now broken for new purchases. The trap is not just the policy itself. The trap is the investors who have not done the numbers on their existing portfolio, assuming the rules that applied when they bought still apply today. They do not. If your investment property strategy depended on negative gearing losses reducing your tax bill, you need to sit down with an accountant before your next EOFY. Trap number 3 is inside your superannuation, and it is the one most Australians will not feel until it is too late to do anything about it. Division 296 lands on the 1st of July, 2026. If your total super balance crosses $3 million at the end of any financial year, the earnings on the amount above that threshold get hit with an extra 15% tax. Effective rate on those earnings jumps to around 30%. Now you might be thinking that number is nowhere near you. But here is what the government is not advertising. That $3 million threshold is not indexed to inflation. It will not move with wages or cost of living. A 35-year-old today contributing consistently with average long-term returns could cross that line well before retirement without ever feeling wealthy. This is not a tax on the rich. It is a tax on the organized. And the only people who will avoid it are the ones who plan around it now, not in 20 years. Trap 4 is the one hiding inside your pay cycle, and it works in reverse. Payday super kicks in on the 1st of July, 2026. Employers must now pay your super at the same time as your wages, landing in your fund within 7 business days. That sounds like good news, and it is, but here is the trap most employees miss. When this change hits, errors become visible almost immediately. If your employer has been quietly underpaying super, even slightly, that gap will now show up in real time. The ATO recovers hundreds of millions in unpaid super every year. A huge portion of that comes from workers who never checked. Log in to myGov after your first July payslip. Cross-reference what landed in your super fund against your payslip. If there is a discrepancy, you have the right to chase it, and the ATO has the tools to help you do it. And trap 5 is the one that cuts across every single bracket. It is called bracket creep, and it is the most passive tax increase in the Australian system. When wages rise with inflation but the tax brackets do not move fast enough, you drift into higher rates without ever getting a real raise. The Stage 3 tax cuts provided some relief, but inflation over the last 3 years has already eroded a significant portion of that benefit for middle-income earners. The fix is not complicated, but it requires action. Salary sacrificing into super up to the concessional cap, now rising to $32,500 from the 1st of July, 2026, is still the most efficient legal way to reduce your taxable income. Every dollar sacrificed is taxed at 15% inside super instead of your marginal rate. For someone on 37%, That is a 22% difference on every single dollar. Net worth. List every investment you hold and when you bought it. Check your super balance on myGov. Then ask yourself one honest question. Are the strategies I am using based on how the tax system worked, or how it works right now? Because in 2026, those are two very different answers. The Australians who come out ahead through every tax change and every budget update are not the ones with the most money. They are the ones who stay informed, get proper advice, and act before the deadline, not after it. If this video saved you from one of these traps, hit the like button and subscribe. Turn on notifications because the next video goes even deeper. I will see you there.